forgot to hit record. Okay, we're recording. Good. Okay, so just a little bit about myself. Our Bookkeepers Bootcamp course qualified for IPBC CEC credits in 2018. With good news, this course or this webinar today does for those who are here for at least 3/4 of the webinar and do answer both poll questions. You will be receiving within 2 weeks CEC credits for this as 1 credit for the 1 hour. I was also the Intuit Global Firm, well, our team was also Intuit Global Firm of the Future for 2018, and we were the Canadian runner-up for 2017. And I'm the recipient of the 2018 Inspire Bookkeeper Award by Alan Salmon and Intuit, and a top 21 influencer in the Canadian bookkeeping world for 2018. Insightful Accountant Top 100 ProAdvisors for 2018. HubDoc Top 50 Cloud Accounting Firm for 2018 and 17. Black Swan Alumni mentoring under Ron Baker. I am a Futurepreneur Canada volunteer mentor, a member of the Intuit Trainer Writer Network, Advanced Certified QBO ProAdvisor, and Certified Desktop ProAdvisor, although I don't deal in desktop anymore. Certified in many apps such as HubDoc, WayPay, T-Sheets. Certified professional bookkeeper through the IPBC with over 20 years of bookkeeping and income tax experience. A little bit about me personally, for anybody who, again, knows me, this will not be a surprise. Anybody who doesn't, just some fun facts. My passions are family and unique experiences. So that's my daughter and myself. With that is not extended family. Those are some of the cast members of our favorite TV shows, Vampire Diaries and Supernatural, that we go and spend the weekends with, I guess, on Thanksgiving. We've done 5 of them with Supernatural so far, which is very, very cool. And then there's Headley and Mary in this Trench, 2 bands from the East Coast or West Coast that we've met. And then that's, of course, my little Rosie, who is also our office manager. And then there is one picture there of myself, my daughter, and I on a cruise, because that was fun. And then my daughter and I are learning ASL together, which is American Sign Language, for those of you who don't know. So this webinar does qualify for your CE credits through the IPBC. There will be 2 polls that must be answered in order to qualify for the credits. And the recording of the webinar will be emailed out to anybody, whether you're here or not, as long as you've registered within 2 days. And the certificates for those who have qualified will be emailed to you within 2 weeks. So just a little bit about KATA accounting. So I've been collaborating with Jonathan and Bob for a number of years. We have multiple mutual clients. I think we're probably close to double digits, if not already there. They do work in QBO. They pay amazing attention to client detail, outstanding customer service. Just a little tidbit for those of you who saw the video for this Firm of the Future. That one client is one of our mutual clients. And obviously she's extremely satisfied with them as well too. So yeah, so they're the top one that if somebody does not have an existing account, they are our top, because we just work so well together. I've been fortunate enough over the years, because they work with me, and they've taught me so much, and that they've helped me become a better bookkeeper, not just from these, but just from working with me and letting me know kind of what they expect or what they do with the information. It's that extra little bit of piece of information that I believe has made me a much better bookkeeper, to the point where I've received compliments from other accountants who have still continuously referred clients to me, but they've noticed a difference as well. So like I say, it's, they were still obviously happy with the work, but they've actually, noticed that I'm now starting to anticipate a lot, which makes their job easier, which makes much better relationships all around. So yeah, so that's it for me. So I will now pass it away to Jonathan and Bob to take over. All right, so we'll just stop share, and then I don't know, whichever one of you wants to, oh, there we go. Jonathan, start screen sharing. That's great.
My computer's doing a little hiccup reset thing. So welcome to our second session about management ratios. We'll get into a lot of detail there, so I'm going to go as quickly as I can. Is everybody able to see the screen okay?
I've only got half a screen.
Yep. Oh, yeah. Yeah, there's only half a screen as well too. It's just the bottom half. There we go.
Got it.
Okay, now we're good.
Okay, all right. So I'm often thought of as a thought leader in accounting and technology. I was a member of the inaugural Accountants Council. KATA Accounting were elite ProAdvisors, Intuit All-Stars, that is, we answer questions on forums sometimes, and winner of the 2018 Inspire Accountant Award. We're big-time collaborators. We want to see the industry improve as a whole, and we want to see businesses better served as a whole. I have extensive experience in the mortgage industry with rental properties, and then as a firm, we do a lot of e-commerce and digital and affiliate marketing, a little bit of software development. Those kind of businesses tend to be our bread and butter for some things. I'm also on the Japanese Canadian Cultural Center board. I was brought in for QuickBooks expertise to help with a system changeover. It's been a very interesting journey with the Cultural Center. It's like steering an oil tanker. It's very slow to change, but very, very pleased with some of the things that are happening. If anybody in Toronto is looking for something to do this weekend, it is our spring festival. So food, entertainment, little shopping out. It's usually pretty good. Usually tracks about, I'd say about 400 to 600 people. So it should be pretty good. I also am an avid MTG poker player and fisherman. So, Bob?
Sure. I'll apologize in advance. I'm dealing with a bit of a head cold, so probably not operating at 100%, but I hope everyone can hear me. I took a graduate work in mathematics at the University of Waterloo, moved to a CA firm, worked my way up to the manager level. Then I moved into industry and worked in a number of companies, starting with oil and gas, working in the financial planning area, which was quite good training. And then I moved out to do independent consulting with several companies, which are listed there. Recently received from the Institute a Lifetime CPA Award, which I'm very proud of. I live in Georgetown, where it's snowing outside right now, with my wife and 4 cats, and I enjoy woodworking, travel. Recently started doing my own car maintenance, just out of interest mostly, and researching the stock market. So I think with that, we can move into the discussion.
Yeah. So in our first presentation this year, we identified a lot of different topics that could be talked about. We're not going to be able to go over all of them over the course of the year, but today we're going to be going over business metrics development. People might be familiar with some of these items being used as KPIs. What we're going to cover are generic items, things that can be done on most different kinds of companies. So there's nothing specific to any client. If you're talking with one of your clients, you might come up with metrics that are completely different and far more relevant to those clients. So financial ratio analysis is just looking at the information and interpreting it in a way to tell a story. A lot of our clients are better learners visually than they are looking at numbers. So these are things that can be graphed, and you can show trend lines and things like that to make it a lot easier for the clients to understand. These ratios will provide an insight into something. So let me just a real quick example. Let's say your inventory turnover ratio in a retail business for the year is 1. That means they only sold 1 group of inventory for the whole year. They're probably carrying too much inventory. They probably got too much capital tied up in there, or they're carrying the wrong product mix. There's something that needs to be investigated there to improve that ratio. So, Bob, do you want to take it?
Yeah. So we wanted to just discuss quickly how these financial ratios can be used and how to get value out of them. So one way to use them is to compare between time periods to track the changes over time. And particularly if a ratio is deteriorating, then it gives you insight into an area that you might want management to take a look at. Another really valuable way to use them is to compare with other companies in the same industry. And actually, as we go through this, we aren't going into a lot of detail about the individual ratios, or we'd be here probably for the rest of the day. We'll introduce them very quickly, but the last half of the webinar, we're going to look at a specific example which shows benchmarking with industry ratios and how you can interpret those and show management or give insights to management about things they should be looking at in their company. So there is a good example at the end of the webinar for the last half probably. You might compare the ratios with recognized rules of thumb for turnovers, or one that I've seen a lot is valuation of industries. So you might calculate some kind of net income or cash flow number, and the general rule of thumb will be that the business is worth 5 times cash flow or some measure of earnings. The next place I've seen them in this, having worked in industry, using them for management bonus measures. So, and being in the finance area, we would calculate the ratios, and then some management person would come and argue with us that we weren't doing it properly. And we usually knew why they were taking a particular interest in that particular measure. So it told us a little bit about some of the management team as well. And ratios are often included in debt covenants by banks and other lenders because they obviously want to control their risk. So if say the interest coverage out of net income is not high enough, in other words, they're not making enough income relative to the interest they're paying, then the bank can take actions to collect the debt, require a pay down of the debt, or some other penalty to the company because they're not sustaining the debt covenants.
I just wanted to pile on here a little bit, just from some of the experiences we've had with VC, private equity. They look at ratios extensively, and improving ratios leading up to either an exit strategy or an investment round or something like that can really improve the multiplier that is applied in the situation. So it is something that, especially if your client is very entrepreneurial and looking for an exit strategy to move on to the next project, that type of entrepreneur, it's very important that their books be in good order, that they have forecasting, that they have budgeting, and that these ratios are paid attention to, and over the period of time leading up to due diligence by private equity or VC, that they show a trend of improvement. So that, although it might be something we really rarely talk about, they're extremely important. So these are just some of the categories of financial ratios. These are kind of generic, high-level ones. Profitability, how are you doing with your profits, essentially. Activity could be things like debt collection, working capital management, inventory turnover might be a good example. Liquidity, that's how much cash you have left. acid test, current ratio, day survivability. Those are important. Day survivability, actually, I think is very important for those entrepreneurs who have a limited runway. So that's a very important one to keep an eye on.
Mm-hmm.
And then, of course, debt and capital leverage become very important when going through a due diligence process of any sort. Bob, what were you going to say?
Sorry, just on liquidity, I was going to say, it's basically, can you pay your bills on time? And that's kind of short-term bills and the current portion of your long-term debt. Are you going to be in a cash crunch in the shorter term?
Okay. And then, Bob, why don't you just finish off the slide? Market.
So, the market, yeah, that's one that you see with public companies. So it's analyzing equities, analyzing public companies, looking at things like earnings per share and dividend payout ratios and that kind of thing. So that probably, or it might have less value to the crowd we're talking about here. I'm not sure there are a lot of public companies that certainly we don't see them very much.
Yeah. Those ratios would still be used by private equity and VC, though, when comparing and determining the multiplier that the company deserves.
Yes.
So just a quick quiz. Now, I'm sure everybody already knows all these ratios, so everybody can get the right answer right off the bat. One of these is incorrect. Which one? Tanya's put up the question. We'll give it just a minute or two for the answer.
Yeah, and then I thought for some reason that there was a spot when I had you email me the answer, I thought there was a place I could put the correct answer. But again, I'm just not used to using the polling part. And so, no, and even if you don't know the answer, just vote what you think. Yeah. Just simply because, again, you need to vote to be able to, it's got to register that you voted to be able to get your CEC credits. So we're going to give some time for that. And then, Jonathan, you can give the correct answer at the end. So we've got 16 attendees, and okay, so people are starting to vote, so that's good. We're at 10 out of 18. So we'll give another 15, 20 seconds or so. I'm getting some more votes. Okay, we've got 12. There's 6 people left to vote. So literally, we'll do 15 seconds down. That is more than enough time. Okay, 10 more seconds.
Tammy's saying she can't get the poll up.
5. She can't get the poll up. Okay, then type in your answer. I don't know why it's not coming up. I mean, everybody else, we've got 13. If you can't get the poll up, type the answer in the questions. Yeah, so Tammy, just type your answer in the questions here then. And if there's anybody else, because we've got 13 out of 18, so there's 5 that haven't voted. If you're having the same issue as Tammy, if you can just go ahead, type the answer in the Q&A, and I'll just make a note, and that'll be fine. So, yeah, if you can hurry and do that before we give the answer. Excuse me. Oh, some people are putting in chat, which is fine. So Dominique is saying that the pop-up or the poll came as a pop-up, which was in a separate window, Tammy. So I don't know if you're still having issues with that.
Probably very bad.
Yeah. Okay, so I'm going to have to close the poll now. So if you haven't already typed the answer either in chat, Q&A, or responded in the poll, then yes, I'm sorry, that's not going to work. So let me just. No, I've got to get back to where did the poll go? Here it is. Okay, so end polling.
Okay, so.
Okay, I'm just going to share the results just in case anybody's curious. They're anonymous results.
I am so impressed.
Mm-hmm.
I am so impressed. Man, there's some good bookkeepers here. Cool. So yeah, so
And
most of the people got it.
are you
correct.
going to are you going to share the correct one? Oh yeah, you are right there. Sorry.
Most of the people
I'll
got
just
it
mute myself and be quiet.
Times interest earned is a debt ratio. All right, awesome. So moving on, shall we move on to the next slide? Yes. I have moved on. I don't know if this pull is up or the slide is up.
Yeah, it's good, Jonathan.
It's good. All right. So profitability ratios. How's your profit doing? Really is what these are examining. These are pretty standard ones. Gross profit ratio. That's one we look at all the time. Doesn't matter who the client is. If we can see a gross profit ratio, we will look at that and we'll ask questions about it. You can quite often find good benchmarking information about what those kinds of ratios should look like depending on the industry. Return on sales, again, kind of similar to the gross profit ratio, but from the bottom line. Return on assets and return on equity and return on investments, all different ways of looking at it. Bob, do you have anything to add about this slide, or we just going quick?
Just the note at the bottom, when you're comparing a number that's over a period of time, like the net income is for a period of time, but you're using and comparing that or ratioing that with a number that is reported at a point in time, for example, a balance sheet number, then the point in time number should be average for the period of the numerator usually. So the third one down, you can see return on assets is the net income. So that'll be for the year, for the quarter, for whatever. So in the denominator, you average the beginning and ending balance of the total assets. Just a little tip, a general rule when you're calculating these.
For these to be meaningful to you, would also strip out anything that's a very unusual activity, extraordinary income, extraordinary expenses. Okay. So these are ones that I like to look at because it tells how processes are working, and it gives you an idea of where you can dig deeper in that value. So receivables turnover, the days outstanding, I know we all look at that. That's a standard report. The aged receivables, aged payables, those are pretty standard reports we look at all the time. One thing to understand is that if there are times when the company gets kind of a cash crunch, one very easy way to help in that situation is to make strong efforts in speeding up your accounts receivables collection and paying the bills a little bit slower. That increases the working capital and the temporary cash flow to the company. Don't do it on, I mean, receivables, yeah, keep them going all the time. But on the payable side, you don't want to create negative feelings with your vendors. So I would not advise it as a permanent strategy, but as a stopgap measure. Inventory ratio, I talked about that at the beginning. How often are you turning over your inventory? This can be used on a very granular level too. So you can look at actual products and look at, okay, so is this product sitting on the shelf all year and we're only selling 50% of it? Or is this product being reordered every month because we keep running out of it? Those kinds of investigations can lead to changes in product mix, changes in pricing strategy, and overall better profitability for your clients. I feel like I'm hogging. Bob, do you want to keep going?
Oh, no.
Okay.
Well, again, from the accounts payable, you can calculate a turnover and a payable outstanding. So receivables, inventory, and accounts payable, you can do the turnover and the days outstanding for each of those. The ones that I haven't seen too often in practice is the operating cycle, but I think that's quite interesting because it measures the full operating cycle. How long does it take you to purchase the product, sell it, and collect the balance owing? So you start out with cash, You go through your entire operating cycle, and now you've got the cash in your hand again, hopefully with some additional profit. But so if you take the days inventory outstanding and the days sales, the number of days sales, that gives you your operating cycle. So I thought that was quite interesting. And then the cash conversion cycle, again, another one that I haven't really seen in practice, but it's how long to turn cash into more cash. So you just take the operating cycle, which we just talked about, and then deduct the days payable. So the longer you stretch out your payables, and I've seen some people stretch them out pretty far. Both Jonathan and I have seen some people do some great, well, strange things with payables. That will improve your cash conversion cycle.
There's a story I always like to tell about about risk and having one customer relates to payables. But yeah, like some of the larger businesses out there that you might think that's a customer I really want to have, you really need to think about that if you want it. Now it's been years, but the last time that I had done in Brad Street up and had a look, Walmart and Home Depot were both over 5 months to pay their bills. So imagine the effect on your customer if they have to finance Home Depot or Walmart for 5 months in order to do business. That's could destroy a business, and actually has destroyed business. Liquidity ratios. These are again the short-term cash ratios. Are you going to be able to meet your payables, things like that? Are you going to be able to survive over the next period, or how long to survive? I think these are good ratios, especially for not-for-profits. They can be very useful. The days, one that's not up here is the days survivability. So essentially it's the cash on hand plus the accounts receivable divided by the average expenses for a day. So maybe you can survive for 30 days or 90 days, or hopefully it's more than a week, things like that. Working capital, this is a question we get all the time. So what we're giving here is the accounting definition of working capital. I've heard it defined many different ways by private equity, by VC, by other investors, by bankers, by even Business Development Canada. So it's very important if somebody asks you what the working capital of the company is, ask them what that means to them. Because we quite often will give the working capital, and then people will be like, no, that's not it. And it's like, well, if you know that's not it, okay, first of all, why'd you ask? But second of all, yes, it is. Like according to the accounting definition, that is working capital. Very, very simple one to calculate: current assets minus current liabilities. I would strip out anything that is an accrued or prepaid. Well,
so debt ratios are measures of the level of debt in the company. And these will be, again, ratios. So you want the level of debt to be appropriate for the size of the business. If there's too much debt, the company will be taking on too much risk. So there are several ratios divided by total assets for both liabilities and equity. And then there's the debt equity ratio, total liabilities divided by total equity. And then the times interest earned, which is how much coverage do I have in my income to pay my interest expense. So you take your earnings before interest and taxes, and then divide it by interest expense. So you're probably looking at least, I don't know, what would you say, Jonathan, 5 times coverage?
If you're getting less than that, then you really,
Yeah.
I would really
I like to be conservative.
Yeah, I mean, to me, that's even still, I would like to see at least 10 times. And it depends on the company, it depends on the industry, and we're talking about, you don't want your debt ratio to get too high, but there can be situations like, I have seen situations, Bob, we met through a situation where one company was cash heavy and they had a lot of other issues and they got bought, and pretty much the cash that was in the company was used to buy the company, more or less. I mean, there was a little bit more than that, but having too much cash on hand and having no debt could be an issue depending on the market that you're in. So, generally speaking, if you have no debt, you're probably not operating as efficiently as you could. Always better to make money with other people's money than your own. All right, Bob. Do you want to do this? Or
the market ratios.
Stocks, so this is like your thing, right?
Yes, but I probably won't spend a lot of time on this. This is an entire field on its own. So these are calculations you've probably heard, and they're often quoted when you're talking about public companies. Things like earnings per share, and that would be earnings per common share, as the formula indicates. The price earnings ratio, so that's the market price today, divided by the earnings per share. How much dividend do they pay out? So do they pay out 80% of their earnings? So the shareholders are going to reap most of the benefits of the company's earnings, or do they pay out a very low amount? Capital intensive companies will withhold most of their income to reinvest. So their dividend payout will be much lower. The dividend yield, like when you buy a share, what percentage of the price you pay will you receive each year in dividends? And then the book value per share, which just is the historical cost of the business divided by the number of common shares. People like to compare that to the current market price. How much above the book value is the current market? But people do a lot of calculations with all of these ratios.
It's interesting that different book value and market value is often used to understand what the goodwill in the market for the company is. Book value is $10, but it's trading at 10 times that, then you're looking at 90% of that value is being attributed to intangible assets. Could be things like patents, their position in the market, all kinds of intangibles. So it's interesting. Oh, the example. We're gonna have to probably go back and forth, right?
Back and forth?
Yeah. So these are example balance sheet and income statement for the next couple slides, I believe. So here's an example of the return on equity. We've got the net income.
I like return on equity as one of the more important ratios that you'll look at, because it's kind of the shareholders who are the people who end up, after all the debt has been paid and so on, what's left for the shareholders. So the return on equity is an important ratio. So this company, their return is 4.6%. You can see the calculation, net income divided by shareholders' equity. And we're ignoring the average of shareholders' equity for the purposes of this example. We know that the industry average is 25% return on equity, and management wants to know what's wrong with their company. Why are other people in this industry earning 25% and they're not? So you can look at these numbers all day and all night, and they're not going to tell you very much. It would only be intuitive that you could figure out what the problem is. So in order to make the specific suggestions to management, we need to do a little work on breaking down that return on equity number into a number of different ratios, which we start to do on the next slide. So we kind of break return on equity down into components. So working on the denominator, which is 1400, you can see that that number is, we're going to link the numerator and denominator through the total assets number, through the $2,500, as you'll see at the end. And if basic algebra scares anyone, you can take a phone call or kind of go and work on a reconciliation for a few minutes, and then we'll come back at the end and you can see how return on equity can be broken down into a number of different financial ratios. But we just wanted to go through the derivation of how we get to those ratios. So hopefully that formula is pretty straightforward. Or if you want to put it into financial ratio talk, the ROE is equal to the return on assets, which is 65 divided by 2,500, divided by the equity ratio. So we've already started to break the ROE down into several specific ratios. Excuse me. Do you want me to keep going, Jonathan?
Yeah, that's your example. Run with it.
Well, I love this because this is real life. This isn't all those definitional things. This is, you're really trying to do something for a company or a business. So now we have return on assets in the formula so far. So we can see that the net income, 65, is the sales minus the cost of sales minus all the expenses. So if you work that into ratio parlance, it's the net income, 65, is the sales times the margin percent minus the expense ratio, where sales is 1,000, the margin percent is 400 divided by 1,000, and the expense ratio is the total expenses divided by sales. So the numerator now becomes, it can be replaced by this formula. And we see that in the next slide. Which is coming up right now.
Is this the slide, Bob?
Yeah. So the final step is to tie the two previous slides together. Remember in the introduction, I said I worked on mathematics degrees, so I kind of enjoy working my way through this. Some people may not enjoy it quite as much, but I wanted to give the flavor here. And I must admit, even when I was going through and preparing this, I got some of my multiplication and division signs mixed up, because you've got things in the denominator that you want to put in the numerator, which turns the denominator fraction upside down. But if you replace all of the numbers, the 65 divided by 1,400, this is what you get. You get assets times the asset turnover. So what that is, assets are 2,500. The asset turnover multiplying takes you to sales. So those two factors multiplied together gives you the 1,000 sales. And then when you multiply it by the margin percent minus the expense ratio, that takes your sales number down to the bottom line. So that represents the 65 in earnings, and the denominator is the assets times the equity ratio. So it's the assets times the percentage of equity that you have on the right-hand side of your balance sheet. So you get 65 divided by 1400. Now, using algebra, you can knock out the assets in both the numerator and the denominator because they're common factors. So what you end up with is the ROE, return on equity, is the asset turnover of the company. How good are they at making sales out of their asset base, times the expense factor, which is their margin and the expenses, and that's divided by the equity ratio, which is a representation of the equity. And just for proof, I put down at the bottom the numbers, the calculations, and we do indeed end up back at 4.6% as the return on equity. So that was all fun and games. Why would we do this? Well, we would do this because we wanted to compare the 4.6% return on equity of this company to 25% for a general company. So now that we've broken down the return on equity into components, and all those components for various industries, those type of ratios are available, we can compare how this company is doing on a specific basis with the general industry and why we're having trouble and not meeting industry standards. So you can see here the asset turnover is less than half of industry. The margin percent is pretty close, it's in the ballpark. The expense ratio is, actually expenses are lower than industry, so that's good. And the equity ratio, 56%, is double 28% the average industry. So on the income statement side, you would say this company is fine. They don't really have any problems. The problems are on the balance sheet and converting the balance sheet into industry. So asset turnover, it means they're not making enough sales for the assets they have. And the equity ratio, that's saying that they have too much equity. They're bulked up for the size of their business. So the conclusions, as I've listed them down there, the income statement is fine. Issues are with the capital structure, too much equity or not enough debt. And in order to determine which of those two it is, you have to look at the size of the company. If the company is properly sized the way it is at $2,500 in assets, then you should be taking on more debt relative to your equity and paying dividends back to shareholders, for example, to reduce equity. And also, because of the asset turnover ratio, we're not producing enough sales for the size of our assets. So solutions are for the business. This is the advice you're going to give them. Examine why assets are being used inefficiently and find a way to reduce the equity relative to debt. And then the subsidiary question is the company correctly sized? The balance sheet isn't matching the income statement. So they either need to bump up sales and still keep their expenses in control, so keep the margins and keep the expense ratio at the levels they're at. So they can either bump up sales or they can reduce the balance sheet.
Okay.
So this was meant to be just a little helpful example that would show you how ratios can be used.
So just before we move on to the poll question, I'd like to add on here. I recently went to a very interesting seminar about preparing business for sale, and there were some shocking statistics that I learned. Probably the biggest is that 70 to 80% of businesses don't sell. 70 to 80% of ventures that are started just fold in the end. So there's an opportunity here where baby boomers control 2/3 of private businesses out there, and they're probably going to be looking for an exit strategy. So there's a lot of opportunity here for us as a whole to add value to those sales for those business owners. These kind of ratio examination and starting to look and examine these years ahead and bringing them into line will help your customer get a better price for the business. To give you a very quick real life example, there is a business I worked with in the past where the owner essentially got an offer and was very eager to cash out and sell. They really hurt themselves because they went into the process too quickly. If they'd waited a couple of years, I'm guessing they probably could have gotten about 100% more for their business than what they did in the end. So there was a lot of money left in the table in that example, and that was largely a communication breakdown and just not knowing that the customer was eager to sell their business and was looking to do that when all the systems were implemented, designed, the value pricing agreement was made and things like that. So to me, it didn't make a lot of sense why they sold. I mean, they had a beautiful cash cow. They should have just kept milking the cow until they were retired, but different people have different motivations. All right. Oh, this is a good question. This is a good question. So we're on to the next poll question, Tanya. Does anyone here have a client who has debt covenants that require to report regularly on certain financial ratios? Does everyone know what a debt covenant is?
Sorry, I was having just trouble launching this second. I don't know why it's not. Oh, here we are. Okay, sorry guys, here we go. Poll's launched.
So we'll give that a couple minutes. Everyone's okay with what a covenant is? Okay.
So you've got 10 out of 20, 11, 12, 13. We're moving up there. Okay, so we've got 16 out of 20. So we'll just give it a couple, like 15 more seconds. Because again, you've got to answer both polls to be able to qualify for your CEC credits. 5 more seconds. All right, we will end the polling and we'll just share those results.
Interesting. So I'd be very curious, is it mainly because people don't have clients who have bank lending, or is it that they're getting lending without any covenant? Very curious about that. Covenants do tend to take effect a lot more when the dollar values are higher. So, all right. And I believe that's it for today's presentation. We've covered Bob, and it was a lot of very technical things. Bob, did you have something you wanted to add?
Yeah, Darlene has a good question. Where can I find industry financial ratios to compare to my butchery shop? And Jonathan, you've said Industry Canada, which is certainly one place. One thing I do at times is I look at when a business files, these are corporations, when they file their federal tax return, they have to put in an industry code, a 6-digit code. You'll find it on the first page of their tax return, and that code tracks them and all other businesses that are like them. So yes, the NAICS, right, Jonathan? And you can actually dig in. I don't know if it's through the CRA website. I haven't done this for a while. Or through some, it might be through Industry Canada.
I think it is through Industry Canada.
But if
that's
you get
where
in
all
there,
the NIACs and stuff end up. So.
Yeah. So if you get in there and you look at that 6-digit code that your client is using, all other businesses that file federal tax returns will use that same code. So it and they assemble averages for the industry. So you can dig out a lot of good information about a general industry using the NAICS code.
If anyone's looking for a place to start, I would start with benchmarking. How's your margin compared to other companies in the industry? That can always be a telling one. Looking at what would be another good example from that? Inventory turnover. If you can back those ratios out from your industry benchmarks and figure that out, that can tell you about how efficiently you're using capital, things like that. So there's a lot of good places to start. I'd say another one that's very useful, of course, are the liquidity ratios for any cash strapped business or cash sensitive businesses. So we're open for questions. Haven't seen any come through yet.
It was a lot of, like, as you said earlier, it was a lot of technical information. So I bet you a lot of people are probably trying to process. Poor Sanders over here, and she's just started to go through like the Knowledge Bearer courses and just starting to learn the back end of it. And yeah, I could just hear her like head spinning. I'm like, don't worry, it'll all eventually make sense.
Keep in mind, we went over very standard stuff. You know, you could always make up your own. Right, like number of sales calls versus conversions versus, average revenue per new sign up. And then you can break that down and look at where those leads are coming from and how efficient those lead processes are to decide if you want to continue to invest in getting leads from those sources. Sherry Lee has the most basic. The most basic I would start with would be gross margin and liquidity. Currently, we are using Excel. Well, actually not Excel, Google Sheets, but whatever, same thing. It's a very basic thing. We haven't explored too many apps that use these ratios. What I'm finding with the app world and some of these things is they read the software in a certain way. If you have any workarounds set up, it won't read the data correctly. And there's no room for judgment. And sometimes you have to use judgment to maybe strip something out or add something in to make the ratio more meaningful. Inventory turnover. So inventory turnover it's a very common place where people get themselves into trouble at the beginning. In particular, restaurants. They'll invest in a lot of inventory up front. And then if they don't get the sales, you can end up with spoilage in the case of restaurants, which goes straight off the bottom line. And then, you could find out that you've ordered far too much inventory and, it's an inefficient use of capital and could leave you cash strapped because you have to pay for that inventory whether you sold it or not.
If anyone watches Marcus Lemonis on a show called The Profit, he goes in and invests his own money in businesses he might be interested in, ice cream companies, hamburgers, but companies that have a quality product but are having financial difficulties. But he is absolutely fierce about inventory management. And like last night, I watched an episode where he went into this wine shop, and the owner was a bit of you might call him a wine snob. and he had rows and rows and rows of bottles of wine, and none of them turned over, or few. Some of them he had good turnover, but a lot of them, they would go a year without making the sale of a single bottle. So Marcus did a very quick kind of analysis, and they dumped, not dumped, they sold at a very low price a lot of very good wines. So he is really big on inventory turnover, and he does end up turning around a lot of businesses that have potential, but it isn't being realized because of bad management practices. So it's a pretty fascinating show if you ever have a chance to watch it.
Well, Bob, I don't watch a lot of TV, but now I guess I might have to make time for that.
Yeah, it's really, and it's one of the interesting things is a lot of the issues are personality related. The owners either quibbling with each other or not appreciating and respecting their staff. It's just very instructive.
Some interesting comments here from Dominique in the chat. I understand what you mean about the AS400. You can do a lot of stuff with spreadsheets and set it up so that all you do is throw in a trial balance or throw in your balance sheet or your P&L, and the ratios will automatically be calculated on another tab. You can do some different things like that to kind of help quasi-automate those processes. And yeah, in any inventory-heavy business, and in e-commerce, this is one of our biggest challenges. Managing inventory is very important. I'm sure people have heard of concepts such as just-in-time. Everybody knows FIFO, LIFO, average, but like there could be a lot of opportunity to free up working capital by managing inventory. And the last thing you want to do is have sales you can't fulfill, and that happens quite often due to poor forecasting. That's when you get back order situations.
So I'd like to ask Dominique a question. When you created and reported these ratios, how many times did you get questions back, or you had to do a more detailed analysis? I've seen times where all kinds of monthly reports are done, and they're sent out to management, and you never hear anything back from management. Just like they don't even read it. That really bugs me when that happens. So did you get any response or anything that showed your reports were well used and respected by management?
And then just to let you guys know as well too, while you're waiting for Dominique to respond, some people, I'm not sure if you guys can see, some people are typing in the Q&A, and some people are typing in the chat. So just making sure that you were aware of that.
Oh, management were owner operators. They're more likely to take an interest, and they probably have their own pet ratios that they like to look at. They'll pick them out of the report.
Owner operators might come up with some new ideas too. So Tammy had a question about Xero showing the ratios on the dashboard, and do we know if there's software out there that will compare automatically? I'm not sure what you mean if you're talking about comparing the ratio within the company or the benchmarking. I haven't seen anything that will do the benchmarking, but KATA will give you a lot of these ratios over time. So like you could go to KATA and say, what's my current ratio for the last 5 years or something like that. That could be very useful. And Marie, I am just going to paste in there this one of the places where we look. So it's the financial performance data. I don't know. I don't think that went out to everybody, did it? Did everybody see that answer in the Q&A? I pasted in general chat as well. Hey, they've updated their data. That's great. Last time I looked at it was based on 2011 data. Government moves so quickly. All right. Well, are there any more questions, comments? So I just pasted the link in chat. Dominique said she can't see it. Paste it again. Still can't see it, Dominique? The regular chat?
Yeah, I can see it. I'm not sure if...
Oh, that's strange. Okay. Well, how about
It
this?
says to all panelists. Oh, no, because you put it to all panelists, not all...
Oh, my bad.
All panelists. Yeah, you've got to go down to tick off all panelists and attendees. There we go.
Sorry, my bad. My bad. All right. Thanks, Tanya.
Great.
Well, I think we're a bit over time, unless there's any more questions. I mean, we're okay. Any more questions or anything, happy to continue.
All right, yeah, that looks like about it.
Thanks, everybody.
Wonderful. Yes, thank you so much for attending. So we'll have the webinar go out again within the next 2 days. You'll have the webinar link, and then CUC credits will go out within the next 2 weeks. And then hopefully the next one, again, we've got to just submit one topic at a time for the CUC approval, but certainly we're not expecting, as long as they see value in the topic that we presented, this should be continuing on every month. But again, I won't be able to verify that the next one is CUC eligible until we actually get the confirmation and start.
I'll shoot
Perfect.
you the application shortly, Tanya.
Awesome. Sounds good.
Okay.
Wonderful. So thank you so much. Thank you so much again,
Thanks,
Jonathan
everyone.
and Bob.
Thanks, everybody.
Okay. Okay, thanks. Take care, everybody.
Take care. Bye.
Bye.